Why is diversification so commonly misunderstood? I'm Mike Loader. Investment Insight starts right now. Hello everyone and welcome back to Investment Insights, presented by the team at The Investor's Way, where each episode we provide informative interviews about wealth creation alongside practical tips of how you can master your money. In today's program, we provide and discuss diversification in investing. Joining me now is Andrew Woodward at The Investor's Way. It's wonderful to have you in studio. On the simplest level, what is diversification?
Good to be back with you again, Mike. And look, diversification in simplest terms that I can give it to you is a risk management tool that people use to moderate the risk in their investments so that if something goes wrong in one part of their portfolio, it doesn't impact all of their investments. So it's literally risk management and a spread of that risk across all of their portfolio.
Absolutely, and it's important to do, I'm thinking of the term, all the eggs in one basket. We want to avoid sort of doing that. But why do you say that it's overused as a term and I guess misunderstood in the investment space?
Well, the reason I say it's overused is because it is actually misunderstood. So you've kind of just stolen my line with all the eggs in one basket.
Great minds.
Yeah, great minds, exactly. And it is that concept that you don't want to have all of your eggs in one basket. But that then leads to this misunderstanding that I need to have it in lots of baskets.
Right.
And so people then take on diversification as meaning if I spread my investments across a whole host of different investments, then I've built diversification into my portfolio and I must be doing the right thing. And it's not necessarily always the case. I had a client, for example, who had more than 60 stocks in his portfolio. And when we dived into the detail, almost 20 of them were the same thing. And so there was no diversification.
Right, it was the idea of diversification that wasn't actually in action and of course working for your client. But what are some of the strategies for incorporating diversification successfully within an investment portfolio? Yeah,
so look, we start out looking at two things. So you've got asset class and you've got time. So asset class is things like we can invest in stocks, property, crypto these days, term deposits, bonds. So we've got a lot of different things we can invest in. So that starts at asset class level. Then we've got time, and this is where it's very much misunderstood, but time is another way of building diversification into your portfolio.
Tell us more.
So you can have short-term and long-term investments. And even say if you look at the stock market, you can have short-term goals and long-term goals. Property market, predominantly a longer term investment. But we can build both time and asset class as tools in the diversification army, if you like, and build that diversification across asset class and time to mitigate our risk. So again, in property, we've got residential, we've got commercial, you've got houses, units, duplex. Yep. So there's different ways that you can build diversification into your strategy to ensure that, going back to again, we don't have all our eggs in the one basket. And what I encourage people to do is think of both.
Right, and what's coming to mind now is time is money, is sort of what I'm starting to recall. But as an investor, which you keep encouraging me to become, and I've done some research a little bit, how do you know I'm going to do the right thing when I jump on those online portals, talk to my bank, talk to financial advisors, etc.? How do you know I'm not going to fluff it up completely?
Well, the first thing is I'm going to keep encouraging you to be an investor until I win that battle. So I'm not giving up on you. You're a work in progress, but we'll get you there. But knowing whether or not you're doing the right thing comes down to looking at your portfolio in totality.
Yep.
And looking, like I said, first of all, look at what asset classes you've got. And we Australians are encouraged, brought up to believe, and wholly invested in property.
Very much so.
And so when I'm talking with clients, it's almost entirely their portfolio is tied up in their principal place of residence and maybe one more investment, which may be another property. So they're entirely in property. So when you're looking at how can I ensure that I'm going to be successful with diversification or with managing the risk of my investments, first thing to look at is, well, how many asset classes are you invested in? And if it's only one, then that is something to think about.
Absolutely.
Particularly when it comes to retirement, and you've got all your money tied up in property, it's very hard to get it out of property in a short time frame. So that's another reason to have diversification, is the cash flow. So have a look at where your investments are, and then again, look at the time frame. Am I all in long-term investments, or do I have a spread where there's some short-term, some medium-term, and some longer-term?
Some very good advice from you.
Yeah, so that comes from things like short-term term deposits, medium-term bonds, and then longer-term share and property investments.
Some good advice from you, Andrew. As always, I look forward to seeing you again very soon, and hopefully as I continue my journey to being an investor, with your help.
We'll get you there.
All right, that's the program for now. Head to theinvestorsway.com.au for more information. And of course, the information provided in this program is for general informational purposes only and does not constitute professional financial advice. Always do your own research. I, of course, look forward to seeing you all again very soon alongside Andrew for more on The Investor's Way.
You're watching Ticker. We'll have more in just a few minutes.